Welcome to Equal Ground Headlines. I am Sir Jacob Downley, bringing you balanced coverage on our top stories of the day. If you appreciate journalism that explains, not inflames, hit like and subscribe to Equal Ground Headlines. Economic storm clouds are gathering over the United States, even as some silver linings remain. In the first quarter of 2025, the U.S. economy shrank by 0.3%, according to official data. It was the first contraction in 3 years, an abrupt reversal from a 2.4% growth rate in the previous quarter. This dip has fueled fears that the nation could be sliding toward a recession. Analysts say one key factor was an unprecedented surge in imports early this year, as businesses rushed to stockpile foreign goods before Trump's tariffs hit. That buying spree inflated last year's growth but left a vacuum afterward, contributing to the GDP decline. Softer consumer spending and cooling business investment played a role as well. Yet, despite the output slump, the job market is still showing resilience. Employers added 177,000 jobs in April, a solid number that actually exceeded economists' expectations, albeit a bit lower than March's revised 185,000 gain. The unemployment rate held steady at 4.2%, near historic lows. In sectors like healthcare, transportation, and hospitality, hiring remains robust. Wage growth has moderated to around 3.8% year over year, which is enough to give workers modest income gains, but not so high as to stoke inflation. In fact, wage increases are now roughly in line with the Federal Reserve's inflation target, indicating price pressures have eased markedly since the highs of a couple years ago. The R word that the labor market is demonstrating is resilience, certainly not recession, noted Olu Sonola, head of U.S. economic research for Fitch Ratings, interpreting the April jobs report. By that measure, the economy is bending, not breaking. Employment is still growing, just at a slower pace than last year. This mixed picture has left policymakers and the public divided on how serious the situation is. Many Americans are uneasy. After 2 years of high inflation eroded purchasing power, people have been looking for relief, and now talk of a possible recession is adding to anxiety. Surveys show consumer confidence has wavered, and as NPR's Asma Khalid reported, new figures showed that the U.S. economy shrank. You see that in the polling? A lot of Americans don't think everything is actual. High-profile layoffs in some industries, for instance, tech companies, and volatility in the stock market have also shaken sentiment. Gasoline prices, while down from peak, remain elevated. It all contributes to a sense of uncertainty on Main Street. The White House, however, is projecting optimism. President Trump has been downplaying recession fears and pushing back against the gloomy indicators. Over the weekend, in an interview excerpt on NBC's Meet the Press, Trump was pressed about Wall Street's recession worries. He brushed them aside, insisting, "This is going to be the greatest windfall, and that everything's oak in the economy." In Trump's view, the economy is in a transition period, after which it will do fantastically in the long run. He believes his tariff strategy and other policies will ultimately benefit American producers. Trump has also pointed to positive signs like cooling inflation. Indeed, inflation has come down sharply and is close to the Fed's 2% goal. To argue that the U.S. can weather this transition without a full-blown downturn. Notably, he's urging the Federal Reserve to cut interest rates to stimulate growth, tweeting on his Truth Social account that there is no inflation and that the Fed should lower its rate. That stance is somewhat at odds with the Fed's approach. While inflation is lower, Fed officials have been cautious, saying they would ease policy only if necessary. Still, markets are beginning to anticipate that the Fed might reduce rates later in the year if the economy continues to weaken. So where does that leave us? At the moment, the U.S. economy is sending contradictory signals. 1 quarter of shrinking GDP doesn't guarantee a recession. It could be a blip, especially given the still healthy job creation. Consumer spending could pick up again with stable gas prices and rising wages. There are also massive government investments in infrastructure, green energy, semiconductor manufacturing, in the pipeline from legislation passed in previous years, which could provide a buffer. However, if the trade disputes intensify and the global economy slows, U.S. exports and business confidence could suffer further. Much may depend on whether the trade war starts to resolve or worsen. Tariffs tend to initially boost inflation by raising import costs, then dampen growth, a tricky combination. For now, Americans are getting somewhat mixed messages. Robust help-wanted signs and low unemployment on one hand, headlines about GDP decline and economic angst on the other. The coming months should bring more clarity. The April jobs report strength suggests the second quarter began on a positive note. If subsequent data, like consumer spending or industrial output, follow suit, the first quarter contraction might be an outlier. If not, the chorus of recession warnings will grow louder. In any case, the debate over the economy has clearly become a centerpiece in Washington. President Trump is keen to reassure the public that his policies will pay off, while critics are watching closely for any sign that the transition he touts is veering into an economic downturn. It's a delicate moment for the world's largest economy, trying to maintain momentum in the face of significant headwinds.